the volume today or the open interest, and that would give me the positions that I want to see that match that criteria. That's one of the filters you can use. Right now on the exchange there's a problem where our data vendor did not receive open interest this morning. So if I used an open interest screen of greater than 0 right now, it would have come up with no results. Just a quick thing in the progress, and we're probably going to have that fixed real soon. Rich wanted to know, can you show gold stock optionality? I'm not going to be able to because I'm already slightly over time. I want to run through these two things discussing the income methods because we promised we would do that. But Rich, if you send me an email to support@radioactivetrading.com, I can easily discuss with you some of the opportunities that the search tool would provide on a particular stock and any questions that you have about that. So I'll encourage you to send that email after the presentation. Barry wants to know, does the calculator have the ability to present dynamic graphs like TOS? Well, it does show you the range of if you have the profit and loss at expiration, and then you have the curved graph every time you make a change and run the simulation of what would happen if the stock was trading here. That curved red line is showing you the profit and loss at that point. If you want to see the standards of, see the charts that have what would my position look like in 2 weeks, 3 weeks, 5 weeks, 8 weeks, 10 weeks, 15 weeks, 20 weeks, and so forth, all in the same chart. I mean, we are going to do some enhancements to that, but no, we don't show the graphs like that. It just gets too overly complicated at one point or another, so we've never added that in. But we'll have some features added in the near future. Okay. Is it possible in this market to bulletproof with income method number one? A lot of people have been asking these questions. Well, I'm going to be honest with you. It depends on the market conditions. It depends on the stock selection. We saw that Sybase example where we had $1.61 at risk. The stock moved up. The 35 call was sold for $1.61, which canceled the risk. Well, let me show you a recent position with income method number one, which is given away for free in the sketch, selling a call. On May 21st, 2010, silver stock, Silver Wheaton, so Rich, I'm going to discuss a silver stock here, kind of mining stock, but not a gold stock, but we'll talk about that later. Purchased shares of Silver Wheaton at $17.20. At the same time, I bought a December put, so it's 7 months out in time. I bought the 20 strike put, about $2.80 in the money, for $4.30. So my total investment on the position was $21.50, but I'm guaranteed an exit of 20 points. So what am I risking here? I'm risking $1.50 or 7%. Yes, that is at my maximum threshold that we discussed earlier using the search tool there. Okay? So what happens? Now I had to put these slides together quickly when I found out Kurt wasn't going to be with us, so I've apologized for some of the formatting. I entered the Silver Wheaton position. 1720 was right in this range here when I purchased it, around May 28th when I purchased the position. Saw Silver Wheaton move up. I actually didn't do an income method at this first jump, and I missed it. And Silver Wheaton came down a little bit, but then it came back up in price. And yes, I realized I just sort of drew a happy face there, and that was not my intention. But what I ended up doing after the stock moved up, this is on 6/28 when it moved up the second time. What I was able to do is use the PowerOptions tools to analyze a potential income method, and we're going to show that in just a second. So 6/28, Silver Wheaton opens at 21.45. I missed the first jump, but I got the second jump. My initial risk was $1.50. I was able to sell to open the August 21 call. Now, why did I want to use the 21 call? Well, I could have used the 20 call, but it was now in the money. When using income method number one, I'm only going to use the 20 strike or higher because that's the strike price of my put. I don't want to rush in too soon and sell a call below the protective put strike price. But I was able to sell the August 21 call for $1.48. So, assuming if the call expires worthless, I believe it was 55 days away, my new at risk on this position would be only 2 cents. The stock moved up as I expected. Used the PowerOptions tools to analyze an opportunity, and I saw that I could sell the 21 call for a reasonable profit and cancel most of my risk, just about bulletproof. Well, how would this look on PowerOptions? Let's go ahead and take a look. I'm going to go into the portfolio tools. After you've identified a position, run your what-if scenarios, done your analysis, you would add it to the portfolio to paper trade and track the position. EPB is another position we're going to talk about in just a moment, but let me pull up the SLW trade. Now, Here's my original position. I've entered it twice here just for the view. My original position on top, one married put, bought shares of stock at $17.20, bought the 20 put for $4.30. Now let's just go ahead and take a look at the initial profit and loss chart on the position. We'll see the standard hockey stick graph risking 7% or $150, and I have an infinite maximum risk. Now we're going to take a look. As I'm tracking this position, the stock has moved up. Now it's still moved up. It's at 1935. There was a dip that we're going to look at in a little bit, but it's moved back up. So if I just had the married put in place, and now I wanted to analyze what could I do next, what we'll do in the portfolio tools, we're going to click on Position Actions and Position Analysis. This is going to link us to a page which gives us a breakdown of our original position. We're going to be able to view the profit and loss chart again of that original position and see where we stand right now. Okay, so we see the similar profit and loss chart, current option bid, current risk. As I scroll down further, I can see my original position value of $21.50 or $2,150. I do have a gain right now of 0.7% after 74 days, but that's not good enough for us, is it? We want to generate some income. We want to enhance that return. And if I held this all the way to expiration, made no adjustments, and the stock stayed at 1934, well, I'd have a loss of 7%. That's the maximum we entered. Well, as we scroll down, we now see that we have some rollout opportunities, don't we? We may consider, here's income method number one, we may consider selling a call. Well, I have the August 20 and the September 20 call that are available right now, call bid of 80 cents and 37 cents. Remember, our maximum risk was $1.50. And if I go out further to September, oh, it's 80 cents. The August 21 call, which is pretty far out of the money right now, only has a bid of 13 cents or 47 cents if I go out to September. So maybe these don't match my requirements. But if I wanted to analyze them further, let's just take a look at that August 20 call, small premium of 31 cents, only 18 days left to expiration. If we wanted to simulate what this would look like if we applied this potential opportunity to our married put, we use the More Information button next to the Rollout Opportunity, and I'll click on Simulate Trade New. The simulation on the left in the red is our original position, current return of the 0.8, maximum risk of 7%, and then over on the right we're shown what would happen if we sold this August 20 call for 37 cents. Now, we don't do too well on this one because the premium's lower, and we do reduce our maximum risk to 5.4%. We can make a potential turn of 3.7%. The stock's not really trading as high as we want to. And down below we see the graphs. Now let me clean this up a little bit. This red line shows us the original profit and loss, the original married put profit and loss chart. This curved black line shows us what we'd expect to see on August expiration. Why August expiration? Because that's when we're going to look to sell the call. So I can compare what my position might look like theoretically if I don't do this adjustment, and this blue line shows us what would happen if we do sell this income method number one against it. Hey, that's pretty interesting, isn't it? Small bump, but not a lot. All right, let me go ahead and close that down, and let's go back to the portfolio. Now here's what we did. Here's what we were able to do after the stock had moved up in price. Okay, we saw it on the chart. We sold the August on 6/28. We sold the August call for $1.48, and it's actually declined now to 15 cents. I should really consider buying the close of this right now and maybe looking at another opportunity to generate more income. But the Power Options tools can show me that too. All right. And here's what we're going to do. What happened to this position when I added this call and almost bulletproofed it? Let's take a look at the profit and loss chart of my existing married put with income method number one, essentially with a collar. Essentially what I have is a collar spread. I've got that December 20 put, and I've got an August 21 call sold against it. So now, if the stock moves back up to $21, the maximum return I could expect is 12.3%. My maximum risk is 0.1%. Was I able to almost bulletproof this position using income method number one in this market? Yes. Did I need the stock to move in my desired direction and meet my expectations before I applied income method number one? Absolutely. You don't want to enter an income method as soon as you open the RPM. We're going to wait for the stock to move up and then sell a call against it or do one of the income methods after the market has made a move. I'm very happy with this position right now. As I mentioned, I might buy this back soon, buy this short call back soon for 15, 20 cents, and then look for another opportunity to generate more income, maybe selling the 20 call or doing a different income method.